In this week's update, Market Outlook 2022 and beyond. Why so many investors fail, and extraordinary strength in battery materials stocks. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Since June, these videos have focused on the very near term. Were we still in a bear market, or were we not? And if you've been watching these videos, you would know that I've been adopting a weight of evidence approach, just looking at how much is on one side of the ledger and how much is on the other side, and coming to a conclusion on that basis, rather than trying to be a hero and make some call that may or may not be correct. But the reality is that markets look 6 to 12 months out, which is why the media is always so misleading, because the media is telling you about what happened yesterday or today's story, and really it's just about gaining clicks or gaining ratings. The media has no real interest in informing us accurately. It's all about their own position. They're not telling us about tomorrow, which is what is being priced into the market. So if you're following the media, then you're completely on the wrong train. So for today, I want to look back at what has transpired in the last 6 to 8 months, and also what are the odds for the future based on the information, based on the weight of evidence that we've currently got. Now, that can always change, and we can change with it. But to hold off investing because something might happen is just not the way to go. And I'll show you very clearly in a minute what I mean. So just a quick recap of what the weight of evidence has shown us since December last year. And that was that money started rotating out of the aggressive sectors into defensives. It was very clear in December, and just accelerated throughout 2022. What I said back then, what I advised members to do, was to raise cash levels, to exit high PE stocks because they would probably come under pressure, and also stocks with no earnings. Now, that process of stocks without earnings visibility getting beaten up, that really started early in 2021 with a lot of the speculative future-facing stocks. But it was quite clear that there was a rotation happening in December. We then got false starts. We got a bounce in March. We got another bounce in May. These are typical bear market rallies. They last for a few weeks, and then they ultimately fail. So there was a couple of false starts. But then the weight of evidence really started to stack up from mid-June onwards. So from mid-June, for about the 3 or 4 weeks following that, the weight of evidence just became very, very compelling, that supported an end to the bear market. And at the time, I said to members that we really should be preferentially focused on large caps in the mega trend sectors, because that is where the money would go initially. And I'll get to that chart in just a sec. And that it would be advantageous to avoid small caps, because the money was unlikely to reward the majority of small caps at that point in time. And furthermore, I said that it wouldn't be a tide that would lift all boats. And again, that is just proving to be the case. And let me show you now Exhibit A. And that is this relative comparison chart. Now, at the bottom, there are 3 indices: the XJO, which is the ASX 200, XEC, which is the Emerging Companies Index, so largely small caps, and also the finance sector, because that is where a lot of investment money goes in Australia. So you can see, and this is over the last 12 months, all starting from a common point. So you can see what the main index has done. You can see what the small caps and what the finance sector has done. But I've selected 3 of the large cap battery materials stocks just to show you the difference in performance over the last 12 months. And I don't need to say too much more. A picture tells 1,000 words. And it's just an extraordinary divergence. So, if you want to be on the right train, then, these are the sort of stocks in conjunction with a very well-constructed game plan. That's where you need to be if you want to do well in this market going forward. So that's the reality of the market that we're in. So it's just so important to keep an open mind and get rid of the greatest profit killer that we have, and that is the need to be right, or the refusal to see what is in front of you. And I still strike too many investors who are still clinging to a position that they took 6 months ago or 12 months ago because they just have this inherent need to be right, and they probably don't even realise that they're doing it. They just can't see what's wrong with the position that they took before. So the big choice for investors where markets are poised at the moment, and I can't tell you with absolute certainty that the bear market is over. The weight of evidence certainly suggests that it is, but I'm open-minded that that could turn back down again, and I've got a plan to deal with that. So the big choice is: do you want to be right or do you want to be profitable? Because in most occasions, those two are not necessarily the same thing. In fact, in a lot of occasions, they're mutually exclusive. So that's a bit of perspective that I hope is helpful to those watching this video. So where are we headed next? Well, I just can't see any other way forward than a continuation of this huge divergence that we've seen all year in sectors and within individual stocks. If you look at a sector in the States like semiconductors, it's a sector that's been struggling. But there's actually a couple of semiconductor stocks that have done really well. So even within a struggling sector, there are still some stars to be found. So what you buy, when you buy it, and how you buy it, whether you buy it in 1, 2, or 3 portions, and how you stage those portions out is absolutely critical. And in my experience, most people don't spend enough time on the planning of what they want their portfolio to look like. So where are the premiums being given? Well, you've already had a look at that from the previous relative comparison chart. But looking at it from a fundamental point of view, it's stocks that have got visible earnings and visible earnings momentum, and they've got a mega trend tailwind at their back. And I've been saying this now, pretty much all year. For now, it's larger caps. We're seeing the money is still going there. There's starting to be a bit of a flow into some of the smaller caps that have got, a very good outlook, and it will increasingly filter down into the smaller cap end of the market. But at the moment, the best reward for risk is still with the larger caps in those mega trend areas. Adding to that, stocks that have got pricing power and an insatiable demand for their product. Now, obviously, in battery materials stocks and other areas such as renewable energy, there is an insatiable demand, and it's outstripping the ability of those metals to supply that demand. So that is where the premiums are being awarded. That's just the reality. Whether you like it or not, it's just where the money is going. So process is vital, as you hear me saying pretty much every week. It's about developing a game plan, simple game plan that's suitable for you. It needs to be simple because complex, won't work. Portfolio composition, it's entirely doable to decide what you want your portfolio to look like, and the balance in your portfolio as the market fluctuations move up and down. You can adjust to go with it. So a great starting point for all this is Portfolio Analyst. It's there's a $1 trial for 2 weeks, and we certainly cover a lot of this sort of material regularly on a weekly basis. All right, well, let's have a look at the American market now. The S&P gained 3.6% for the week, so it was a very good week. Wednesday, Thursday, Friday finished very strongly, and it was a very nice positive finish for the Nasdaq on Friday night as well, and finished almost on its absolute highs for the session. There is a clear rotation back to aggressive stocks again. So that sort of, last week I said the bull case was weakened by what I was seeing in the market, and it flowed through in the first day or so of the last week. But certainly there was a big turnaround on Tuesday, Wednesday, and the US market finished quite strongly. But look, overall, it does remain a rather mixed picture, as you'll see when we get to the charts and the ratio charts. There's certainly it's certainly not as robust as I was looking at 2 or 3 weeks ago, but certainly we're not in a position where you could start to be fearful of the bear market revisiting. Not yet, anyway. Next week is really critical. There's the CPI data, I think, on Tuesday, the PPI data, producer price index, on Wednesday. That'll be critical. If it comes in at or below expectations, along with the lower figure that came through in July, I think the market will take off to the upside. But if those figures are higher than what the market is expecting, then we'll probably see some more weakness. So that data is really, really critical. But certainly the finish to last week would indicate that the major players are putting their money where they think this data is going to land. The US dollar index pulled back a little bit. We got above 110, but we pulled back to just under 109. The 10-year yield fluctuated up and down around 3.3% all week, but it's sort of holding steady there for now. The VIX has come off. It was up in the high 20s a week and a half ago. We're now back down into the low 20s. We had reached an extreme on the put to call ratio, so the market was extremely fearful even just 3 or 4 days ago. And being a very good contrarian indicator, it's no surprise that we saw a short-term bottom. Whether that proves to be, the higher low remains to be seen. And the 10-year, 2-year yield spread, which is indicative of whether there's a recession looming, is still in negative territory. So the odds are still somewhat in favour in the next 12 months that there'll be an effective recession in the States. So let's jump in and look at some charts. All right, so we'll start with the Nasdaq first of all. So we've been forming higher highs and higher lows since the June low, and we almost got back to the 200-day moving average, but then it rolled over again, and we didn't break the lows. So that's the important thing here. So this last lower low that was formed, this last higher low that was formed at the end of July, that wasn't broken, and we've started to rebound. But look, we're not out of the woods by any stretch of the imagination. And what I want to see, whilst the shorter term moving averages are now turning up, which is positive, I really want to see the Nasdaq get back above this 20-day moving average, the green line. So I want to see the Nasdaq back above, let's say, 13,000, and then I'll start to breathe a little easier. But certainly this has been a bit of a concerning last couple of weeks. But the weight of evidence still supports the bull case, and the bull case isn't broken. It's just it's had one leg kicked out from under it, if I can put it that way. Before I get to the other charts, let's just look at some of the key sectors in the States. Consumer discretionary. clearly doing very nicely, surprisingly nicely. I must admit I am surprised by this because I would have thought the consumer was getting really squeezed. But higher highs, higher lows. We've been able to hold this important support level, and it finished the week quite well. XLK, the technology sector, still struggling to a degree. So certainly it's not one of the buoyant sectors in the States. But energy, clearly is. If you look at the 200-day moving average and all the shorter-term moving averages and where the price is in relation to them, energy and renewable energy has certainly been the place to be. Okay, let's take a look at the S&P. So again, higher highs, higher lows. We got down to an important level of support and managed to hold it, and then bounced strongly Wednesday, Thursday, Friday. As I said, the equity put to call ratio had moved into extreme territory earlier in the week, and so not surprisingly, we got a contrarian rally. Now that put to call ratio eased back on Friday, despite the fact that the indices were off a bit early. So from my perspective, when I put all this together in the mixing bowl, the bull case has been weakened, but it's not been killed. So that's sort of how I see things at the moment. So if we go and take a look at the sector spreads. So this is consumer discretionary versus staples. So this really allows us to drill down onto where the money is flowing. And the reason that that's so important is that if you just look at the indices are going up and down on sentiment, and sentiment is flicking backwards and forwards. But what you really want to know, the most valuable piece of information that you want to know is, where is Wall Street committing their money to campaign? Because Wall Street is not shifting, trillions of dollars in and out of the market on a daily or weekly basis. They start a campaign that lasts weeks and months. So where they're putting their money is important, and we are now seeing quite clearly money on balance is, yes, there's a few ups and downs, but on balance we've now got higher highs and higher lows. Money is flowing back into consumer discretionary relative to consumer staples. It's the only conclusion, and it had a very strong week. This is the US semiconductor sector versus the S&P. Now, for a really fair income bull market, you want semiconductors leading the S&P, and you want semiconductors leading technology. And at the moment, they're not. So they're still underperforming. But within semiconductors, there are a couple of little gems. But that is certainly one aspect that I need to see turn around. This is the NASDAQ versus the S&P. We broke the channel, and that was why I sort of rang the bell last week. But it did turn up towards the end of the week, so a bit of an improvement there. Russell 1000 growth versus 1000 value. Again, higher highs, higher lows. We didn't invalidate the uptrend by forming a lower low. This is small cap growth versus small cap value. And again, we're getting the same picture. We've pulled back, but we failed to set new lows. So we're still in an uptrend. This is US large cap growth versus large cap value on a weekly basis. So this is a much bigger look at things. So this first peak here was November of 2020. The second peak was November of 2021. So this is where we're really getting a bit of a mixed picture. We broke support, we then broke resistance to the upside, and now we've broken support again. So it's really just going up and down. So that's a bit of a hard one to decipher. This is mid caps. Now this is pretty impressive, and I do place importance on the mid caps. rather than just where the money is going into the very large cap stocks. So the US mid cap versus or mid cap growth, I should say, versus the S&P. So that had a very good week as well, and also continues quite clearly in uptrend. And that's it for all of those spreads. Just looking at gold while I'm here. So GDX versus gold, it's just been an absolute shocker. Gold stocks have underperformed the metal since April. But we had a better week, so it did turn up. And if you look at versus the gold price versus the silver price, we've also been, and this is typical. When you're in a bear market for precious metals, you will find that gold will do better than silver. They're both going down, but gold is going down less than silver is. So that is the picture for the US market. As I said, the weight of evidence still supports the June low as being the end of the bear market. But I think, just for now, you just got to be flexible and open-minded. The Australian dollar, 67.79 is where we finished. Our index rose 1% across the week. It'll probably get a kick up on Monday, I would expect. The materials sector was the best out there, and battery materials majors were the best of the best. I just don't know of a stronger sector last week, or a stronger group. Turning now to precious metals, gold was up $4 to 1,718, which, when translated for currency, gets us a little bit lower to 25.34. But the Australian gold miners, their all-in sustaining costs are somewhere between $1,200 for the very best and around $1,600 for the also-rans. And so a gold price of $25.34 for those gold miners that are unhedged is still a very, very substantial profit margin. However, having said that, whilst the fundamentals look appealing and they look cheap, it's just not in favour. It's just not a sector that's in favour. As I said last week, US 1680 remains the really big, important level. We're only about $30 above that. And it is important because it's been tested on 6 occasions since 2020. So if that level were to break, you're going to see a big downdraft in gold. So that sort of concerns me about having too much weighting in gold stocks. And gold stocks still aren't really providing a meaningful response. Yes, they turned up a little bit last week, but the ratio of gold stocks to gold is almost at historic lows. And that's why I've preferred over the last couple of years to focus on emerging producers that can gain significant value without the gold price needing to move up. I don't want to be reliant on the gold price to do the work for me, as it would be for existing producers. If you own a Northern Star or a Newcrest or an Evolution Mining, then the price is going to go up and down according to the gold price. Whereas there are other alternatives, emerging producers that are adding value in terms of price because the project is just getting de-risked. I think that's where we need to be. So let's take a look at those charts. Just have a quick look at the ASX 200 first of all, just for the reference. So you can see quite a nice bounce on Thursday, big bounce on Thursday, reversed Wednesday's weakness, and then followed through nicely on Friday. But if we look at, by the way, cryptocurrency, so this is Bitcoin. So Bitcoin had quite a surge on Friday, and you can see the volumes really started to pick up on Friday as well. But leaving that aside, this is gold on a daily basis, so didn't do a lot during the week. And if we look weekly, this is the key support. 1680 is the key line in the sand. If that breaks, then I would expect we're looking at least another $100 to possibly $200 to the downside on gold. That's just the reality of where we're at. Looking at other commodities, copper was up a little bit, and nickel also up from the mid-9s up to 10. So despite all of China's problems at the moment with with a drought, with COVID lockdowns again, with the property sector being in trouble and therefore impacting demand, I was amazed to read that copper imports are higher in 2022 than they were in 2021, and also the copper imports in August were higher than July. So yeah, that's a bit of a head scratcher. But there is a deficit now in copper, which would appear to be around 64,000 tonnes, and the importance of that will become relevant on the next chart. So that's there's a deficit there already. A lot of people are saying, well, the big deficit doesn't start until 2025, but I think that that deficit might be coming a bit earlier than what some people think. Grades, head grades and production output in Chile is down. Chile's the world's biggest copper producer, and these are big mines that are getting depleted. It's normal, but the thing is they're not getting replaced. With new big mines are not coming on fast enough to counteract the depletion in the existing mines. And then on top of that, we've got this massive spike in demand looming. Crude oil, so that's the copper and nickel situation. Crude oil, West Texas Intermediate was lower again, 86.1. And it's really mainly coming from concerns over demand out of China, which may or may not be valid. But I think the long-term outlook for oil and gas still looks pretty solid. Even leaving aside Russia-Ukraine situation or demand in China, if you just look at the long term, there's so much or such a lack of exploration, and demand is not going to fall off a cliff as a lot of people would like. So I think we're going to see higher oil and gas prices for probably a number of years to come. There's the spot copper chart. So we managed to kick up a little bit last week, but let's look at the inventory. Inventories continue to fall, and you can see that inventories now was sitting in the LME warehouse at around 100,000 tonnes. So that puts a 64,000 tonne deficit into perspective. So we're already in deficit. So you can see that that the copper price could get moving again to the upside, pretty quickly. There's the spot nickel chart. It's a little harder to discern because we've got that very big spike that occurred at the start of the year. But nevertheless, it's holding its ground, and there's the 1 year LME nickel stock level, inventory level, and it's it's getting down to extremely low levels now. So it's no wonder that base metals prices have remained reasonably buoyant, and we haven't really had the big tsunami of demand really kick in yet. So wrapping things up. Having a plan and developing your skills over time are your most precious tools. And, anyone who thinks that they can do well in the market by, just getting some recommendations or some stock tips has better have a rethink about what's important. You've really got to be prepared to invest in those things, developing your skills and plan. 3 or 4 years ago, I developed a training course, which is still relevant today. It's called Trading with Precision, Not Prediction. It's available free with membership to either the Insiders Club or Portfolio Analyst. And, they're things that I've learned over more than 3 decades in the market that are important. The things that work, a lot of them, they're not the sort of things that you read in a textbook. They're the things that work in real life. There's also hundreds of hours of archives and searchable stock analysis within Portfolio Analyst. So I think that's a very, very valuable resource if you're looking to upskill yourself. As I said at the start, trying to be right is worse than a wasted effort. It's dangerous because it plants the wrong seeds in your mind and you can't actually see reality. So try and catch yourself out, trying to be right rather than acknowledging what's staring you in the face. And striving for consistency is the important thing. No one on the planet can get all their moves right. If you can get 65-70% right, you're probably doing pretty well. And so it's about the consistent application of a game plan that's important, not trying to be right on every single transaction. Portfolio analyst last week, we did taking stock, which we do once a month, and that is a real full-on skills development forum. So if you're looking for some insight into where you can get access to building your skills, then that might be a pretty good place to start. That's it for this week. More information on the website is my email address, and I'll be back with you next Sunday. Cheers.